Hello traders! In this video, we will have a look at the most important fundamental indicators and how they affect the economy. Compared to technical analysts, fundamental traders look at the variety of economic indicators and reports to get a better understanding of future market directions. Even though most retail traders focus on technical analysis, understanding the fundamentals is always very helpful, especially for swing traders. If we look at the bigger picture and in the longer time horizon, markets are most often moving based on fundamental drivers. There are dozens of different fundamental indicators for different countries, and you certainly do not have to know all of them. Here are the most important ones that tend to have an impact on the markets. Employment reports include employment change, unemployment rates, number of jobless individuals applying for governmental support, level of payrolls, and other jobs-related data. The most famous employment report is the US NFP, which is normally being released on the first Friday of every new month. Changes in the gross domestic product can have a large impact on the foreign currency. An increase in GDP tells us that the economy is strengthening and the currency could be rising. A decrease in the GDP indicates a weakening economy, therefore the possibility of falling prices in the currency. Trade balance represents the difference between the imports and exports of the subject economy, and it has an effect on the demand for the country's currency. There are two possible outcomes: deficit, which means that the country is importing more than exporting, and then also surplus, which is the opposite. The Consumer Price Index tells us prices of products on a consumer level, and it is also a key indicator of inflation. Changes in CPI can directly influence monetary policy, as it is mandatory for most major central banks to control the inflation. An increase in inflation usually indicates an increased rate rise, while lower CPI readings indicate lower interest rates. The Purchasing Manager Index shows the activity of purchasing managers and can act as a leading economic indicator. PMI indicates strength or weakness in the manufacturing sector. Interest rates are part of central bank monetary policy. The leading indicator includes activities and speeches by bank officials that are regularly watched by many traders. Interest rate changes by central banks are very important in the valuation of currencies. If banks set higher interest rates, their currency usually attracts foreign assets from countries with lower interest rates. Most central banks issue statements to describe their monetary policy and why they did or did not make any changes. These statements affect the markets, especially if the changes are unexpected. We use the terms hawkish and dovish in central bank decisions. Central banks are hawkish when they want to tighten monetary policy by increasing interest rates or reducing balance sheets. Being hawkish means strong economic growth. Dovish is the opposite, when banks are reducing interest rates or increasing quantitative easing to stimulate the economy. Being dovish means weak economic growth. Alright traders, this is it for this video. I hope you have enjoyed this video, and if you have any question, or you are just interested in something, or you are struggling with something, just let your comment down below. Please don't forget to subscribe to our YouTube channel, and I wish you steady study and see you next time.